What caused the financial success was not extreme mobility. And I've had results in life that are prodigious. And that came from tricks.
How does Charlie Munger approach investing? The foundation of Charlie Munger's investment strategy is the idea that good chances are scarce and infrequent. He famously observed that life is not just bathing you in unlimited opportunities. Therefore, finding as many good ideas as possible is not the goal of Munger's process. The most well-known aspect of Charlie Munger's career as a millionaire, investor, businessman, and philanthropist is his long-standing association with Warren Buffett. He's both Berkshire Hathaway's vice chairman and a well-known investor in his own right. His approach to business and investing has been extensively examined by people all around the world. Long-term thinking and investment diversification across several asset classes are key components of Munger's investing philosophy. Before deciding to invest in a company, he thinks that potential investors should grasp the underlying business and the intrinsic value of future cash flows. In addition, Munger emphasizes the significance of comprehending competitive advantages while assessing potential investments. He believes that companies with significant competitive advantages have a higher chance of long-term success than those without them because they can hold on to their market share even in challenging economic times. This offers them an advantage over rivals who could struggle during downturns in the economy or in their businesses. Munger supports a methodical approach to investing, one that avoids taking unwarranted risks and emphasizes building value by carefully examining each prospective investment opportunity rather than relying only on chance or intuition. By employing this method, he contends that investors can prosper over time provided they're persistent and patient while avoiding short-term speculation, which frequently results in losses rather than long-term gains. Compounding is a potent strategy for long-term wealth accumulation. Charlie Munger has promoted it as one of the most crucial investing principles, and it entails reinvesting investment gains to produce greater returns. It takes some time for compounding to start paying off, but if done correctly, the rewards can be significant. Compounding works best when done with patience and discipline. Let's imagine, for illustration, that you place $1,000 in an index fund with an 8% annual return. Your initial investment of $1,000 will have increased to $1,080 after 1 year, representing an 8% return. After 2 years, your total return will be just under 16% if you reinvested those earnings into the same fund at an annual rate of 8%. As a result, after investing $1,000 for 2 years, you might have a total of $1,166.40, or slightly more than 16% of your initial investment, thanks to 8% returns compounded on $1,000 twice. When capital begins to profit from prior returns, this is known as compounding returns. Investments in money, as well as other areas like education or professional growth, are included in this idea. If you do it well and often over time, investing in yourself may yield enormous rewards. For instance, attending workshops or classes in your field today could seem unnecessary, but later on when your knowledge and skill set grow, you might get paid more or get promoted. Charlie Munger asserts that wealth creation requires investing in oneself. He thinks that investing in your knowledge and abilities may be as profitable as buying stocks or bonds. You may improve your chances of becoming financially successful by developing new talents, developing relationships with successful people, and taking smart risks. Learning new skills that will make you more marketable to employers or possible business partners is the first step to investing in oneself. To gain a deeper understanding of finance, accounting, marketing, entrepreneurship, and leadership themes, take advantage of free online courses, university seminars, and other organizations. Attend conferences on these subjects if you can to network with people who share your interests and learn how to make the most of the knowledge you acquire. Another strategy to make financial investments in yourself is to network with successful individuals. This may entail participating in community business leaders events or joining organizations where professionals share their knowledge on a range of matters pertaining to job advancement and personal finance. Additionally, search for chances in your current position to network with people higher up the corporate ladder. Doing so could potentially boost your earning potential and increase your level of job satisfaction. When investing in your financial future, it's crucial to remember to take prudent risks. To do this, consider several options that may require an initial outlay of cash but have strong potential for yielding long-term rewards, such as starting a side business. Any risk taken must be carefully considered beforehand, so do your homework before investing money into something that can turn out to be unsuccessful. Charlie Munger's 3 career edicts: never sell anything you wouldn't personally purchase, work alongside people you enjoy, never for someone you don't respect and admire. Mental models are effective decision-making aids. They give us framework to use in trying to understand the world and where we fit into it. Charlie Munger promotes the use of mental models in decision-making. He contends that having a variety of mental models can help you make better decisions and, over time, achieve higher financial success. In essence, mental models are perspectives on the world that we live in. They entail approaching issues from several vantage points, which enables us to generate original answers or concepts that we otherwise might not have thought of. Consider the situation where you are considering investing in a particular stock. In that instance, you could employ the margin of safety strategy, which entails determining the level of risk before spending money on an uncertain venture. The Pareto principle, also known as the 80-20 rule, is another helpful mental model. According to this, 20% of causes account for 80% of outcomes. Hence, focusing initially on finding the most important reasons will yield better results more rapidly than addressing all potential factors. This can be used in a variety of contexts, such as budgeting for projects where there may be a few resources available, but where it's still important to get the most impact out of them. Understanding incentives, or why people act the way they do based on their motives and aims, is another crucial mental model that Munger promotes. The ability to think creatively and from many perspectives before coming up with ideas that would otherwise been neglected provides us with an advantage when making decisions. Additionally, by using these frameworks, complicated situations become simpler to comprehend, facilitating quicker and more informed decision-making while lowering the risks involved in any given circumstance. Charlie Munger's guidance on investing and making decisions in life that lead to prosperity is priceless. His approach to investing places a strong emphasis on the value of compounding returns, investing in your own education and development, and using mental models to guide decision-making. His advice can help you achieve long-term financial success and personal development. You must first explore the fundamental ideas that guide Charlie Munger's investing philosophy if you want to comprehend the mechanics that drive his investment performance. The circle of competence, the ideas of intrinsic value and margin of safety, and his opinions on diversification against concentration are three important ideas that have regularly come up in his speeches, interviews, and shareholder letters. According to Munger, knowing the borders of the circle is more important than its size. He frequently advises against venturing outside of this sector because, in his opinion, doing so will result in bad investing judgments. An investor has a crucial advantage by operating within their sphere of expertise, which enables them to accurately assess information and make informed predictions regarding future developments. Numerous techniques can be used to calculate the intrinsic value, frequently incorporating in-depth financial research and forecasts of future cash flows. Munger does, however, also place a strong emphasis on more qualitative elements such as caliber of the company's management, its position in the market, and its capacity for cash flow. The idea of intrinsic worth is strongly related to the margin of safety premise. It speaks about the gap between a stock's intrinsic worth and its current market price. The margin of safety, which acts as a safeguard against potential losses should things not go according to plan, increases as this gap widens. Munger supports this idea as a crucial risk management tool, minimizing the negative effects in the event that the intrinsic value was computed incorrectly or if unanticipated circumstances have a negative effect on the company. Last but not least, Munger offers a unique perspective on the debate between concentration and diversification. The conventional investment philosophy encourages diversification to distribute risks across a variety of assets. Munger, like Buffett, is recognized for his skepticism on over-diversification though. A common line from Munger is, the idea of excessive diversification is madness. He contends that it's preferable to concentrate on a small number of businesses that fall squarely inside your sphere of expertise, have a high intrinsic value, and offer a sizable margin of safety. But this focused strategy demands a thorough knowledge of the selected investments and a high level of tolerance for short-term volatility. With a nod to his dedication in this circle of competence and his persistent pursuit of intrinsic value, Munger's preference for a focused portfolio demonstrates his confidence in his investing choices. That's all for today. If you like this video, please give us a thumbs up. Make sure to subscribe to our channel and hit the bell icon to receive notifications. Also, express your valuable thoughts in the comments section below. Until then, goodbye. Also, spend some time watching other videos on the channel.